Even if you feel pretty comfortable with your finances, navigating borrowing, saving, well, it can still throw some curveballs, right? Maybe you're thinking about a new car, or perhaps you need funding, and the usual banks aren't quite cutting it. It can feel complex. But today, we're really going to try and cut through some of that noise using the great sources you've provided.
Yeah, our mission here in this deep dive is basically to help you make smarter choices with more confidence. We'll dig into three key things: AL finance, what that actually means, the all-important annual percentage rate, or APR, and why that's your best friend for borrowing, and finally, the absolute must-have emergency fund. We've pulled together some really comprehensive material for this, packed with practical stuff you can actually use.
That's absolutely right. And look, understanding these terms, it isn't just about learning jargon. It's about seeing how they affect you in the real world. Your borrowing costs, your financial security, honestly, your peace of mind. Knowing this stuff really puts you in control. Okay, let's unpack that first one then. AL finance. It's a bit tricky because it seems to mean two different things. Like, on one hand, it's auto loan finance for cars.
Exactly. Specialized financing just for buying vehicles. Think dealerships, specific auto lenders.
But then it can also mean alternative lending finance, which is like everything outside the traditional banks.
Precisely. Online lenders, peer-to-peer, all that. Let's maybe tackle the auto loan part first.
Okay, yeah. How does that usually work?
Well, it's fairly straightforward. You apply maybe at the dealership, maybe directly with a lender. They'll look at your credit, your income, the car's value, standard stuff.
Right.
Then, based on that risk assessment, they set the terms. That's your APR, how long you have to repay, your monthly payment. If it's all good, the money goes straight to the seller.
And the benefits are pretty clear. You get the car faster, payment plans. But you mentioned something about credit.
Yes, that's a key point, often missed. Auto loan finance isn't just for people with perfect credit. It can include subprime lending options. So for someone with, say, a poorer credit history, it might actually be a way in. Managed well, it can even be a tool to help rebuild credit.
Huh, that's interesting. Not just a last resort, but maybe even strategic. Okay, so what about the other side of AL finance? The alternative lending.
Right. This is where things get broader. Think online platforms, peer-to-peer lending, where individuals lend to each other.
Like P2P.
Exactly. Also crowdfunding loans and those buy now, pay later things you see everywhere now, DMPL.
Okay, and who is this typically for?
Well, it often serves people who might struggle with traditional banks. Maybe they have limited credit history or they need money faster than a bank can move.
So easier approval, quicker turnaround.
Generally, yes. And
Yeah.
sometimes you find more niche or customized loan products too. It could be really good for small businesses, freelancers, gig economy workers, basically anyone who doesn't fit the standard bank mold.
Got it. So two distinct types of AL finance, maybe some common ground.
There is actually. Many providers in both spaces, auto and alternative, tend to operate similarly in some ways. You'll almost always see online applications now. For convenience,
Makes sense.
many offer pre-qualification tools, lets you check your chances without dinging your credit score right away. Plus, things like credit score education resources, low down payment options sometimes, and flexible repayment plans. They're trying to make it accessible.
Okay, so there are lots of options out there, whether it's for a car or something else, which leads to the big question. How do you choose wisely? How do you compare these offers? And I guess that brings us right to APR.
Exactly. APR, the annual percentage rate. If there's one number you need to understand when borrowing, it's this one. Because it's not just the interest rate, it's the total yearly cost shown as a percentage.
Total cost, meaning it
The
includes...
fees, charges, all those extra costs associated with the loan. Origination fees, processing fees, whatever they call them. APR bundles the interest and most of those fees together.
Ah, okay, so it gives a more complete picture than just the interest rate alone.
Absolutely. Let's say you have a $10,000 loan offer. Maybe it says 6% interest. Sounds okay. But if there's $500 in fees rolled in, the APR might actually be closer to 6.5% or even higher.
Wow, okay.
And, some products like credit cards, they can have a ton of different fees.
Right.
The APR is supposed to capture the main ones, making comparison much more apples to apples.
So it's basically the key comparison tool, avoids getting tripped up by hidden costs.
Precisely. It reveals the real cost. So always compare the APR when you're looking at different loan offers or credit cards.
Is there, like a quick check, a way to tell if an APR seems way off base?
Well, one thing is to have a general sense of current market rates. If an offer's APR seems dramatically higher than average for that type of product in your credit profile, That's a big warning sign. It likely means either very high fees or the lender sees you as very high risk.
Makes sense. And I know there are different types of APR too, right? It's not always straightforward.
That's true. You've got your fixed APR. The rate stays the same for the life of the loan. Predictable.
Okay.
Then variable APR. That one can go up or down, usually tied to some market index like a prime rate. Less predictable.
Right. Often see those on credit cards?
Yes. And speaking of credit cards, you often see introductory APRs. That's the tempting 0% or super low rate for a limited time.
Got to watch out for when that ends.
Absolutely. And then there's the penalty APR. Mess up like missed payments and they can hike your rate way up. That one really hurts.
Okay, so knowing the type is crucial. How can someone actually work towards getting a better APR?
The biggest factor, hands down, is your credit score. Improving your score will open doors to lower rates. That's number one.
Makes sense.
Second, shop around. Don't just take the first offer. Compare rates and terms from different lenders, banks, credit unions, online lenders. Third, really understand the loan terms before you sign anything. And finally, don't be afraid to negotiate, especially on fees. Sometimes there's wiggle room.
Good tips. But what about mistakes? Where do people usually go wrong when they're looking at APR?
Oh, a few common ones. Focusing only on a low introductory APR and forgetting about the much higher rate that comes later. That's a big trap.
Yeah, I can see that.
Another is not realizing some fees might not be included in the APR calculation, things like late payment fees or prepayment penalties. You still need to read the fine print for those.
Okay. So ATR is comprehensive, but maybe not everything.
It covers the main upfront costs of getting the loan, but not necessarily penalties for how you manage it later. And the last mistake. Assuming the lowest APR always equals the lowest total cost over the entire loan term. The loan length and other conditions matter too.
Right. A lower APR over 30 years might cost more in total interest than a slightly higher APR over 15 years.
Exactly. You have to look at the whole picture. But APR is your starting point, your best tool for that initial comparison and transparency.
It really empowers you to see behind the curtains, so to speak.
It does. It helps you borrow smarter, whether it's a car loan, a mortgage, a credit card,
Yeah.
anything.
Okay. So we've talked a lot about borrowing, but what about, well, avoiding borrowing, especially the expensive kind, when emergencies pop up, which I think leads us straight into the emergency fund.
Yes, the emergency fund. Absolutely essential. It's basically just a savings account that you set aside only for unexpected, necessary expenses.
Like what kind of things?
Think major stuff. Losing your job, suddenly needing medical treatment not fully covered by insurance, your car breaking down needing urgent repairs, maybe a critical home repair like a busted furnace in winter.
Right, the things that knock you off your feet financially if you're not prepared.
Exactly. It's your financial safety net, your buffer.
So unpack that a bit more. Why is it so critical? You called it a superpower earlier.
Well, maybe a slight exaggeration, but it feels like one when you need it. First, job loss protection. If your income suddenly stops, having that fund means you can still pay rent, buy groceries, keep the lights on while you look for new work. It buys you time.
Takes immense pressure off.
Huge pressure. Second, it helps you avoid debt. When that emergency hits, instead of whipping out a high-interest credit card or scrambling for a personal loan, you use your savings. Cash.
Much cheaper in the long run.
Way cheaper. And think about freelancers or gig workers we mentioned earlier. Their income can swing wildly. An emergency fund isn't just nice for them, it's almost fundamental to staying afloat during lean periods.
Good point.
And finally, maybe the biggest benefit is just peace of mind. Knowing you have that cushion reduces so much financial stress. You can focus on fixing the problem, not panicking about how to pay for it.
Okay, totally sold on the why. Now, the big question. How much do you actually need in there?
The million-dollar question, though hopefully the fund is smaller. The general rule of thumb you always hear is 3 to 6 months worth of essential living expenses.
Essential expenses. So not like vacation money or eating out.
No, exactly. Rent or mortgage, utilities, food, transportation, insurance premiums, minimum debt payments, the absolute must-pays.
Okay, 3 to 6 months. But does that vary?
Oh, definitely. It depends on your situation. How stable is your job? Are you the only earner? Or do you have a partner contributing? What are your fixed monthly costs? Do you have dependents? Any ongoing health issues?
So it's personal?
Very personal. For example, someone single with a very secure job, maybe low expenses, 3 months might be fine. But a freelancer with fluctuating income, or a family with kids, and maybe just one main income source, they should probably aim for the higher end, maybe 6 months, or honestly even more if possible. Some experts say up to 12 months for highly variable incomes.
Wow. Okay, so calculate your essential monthly burn rate, then multiply by 3, 6, or maybe more, depending on stability.
That's the process.
All right. And once you figure out your target number, where's the best place to actually keep this money? Under the mattress.
Huh. Probably not the best idea. No, you want it somewhere safe, but also easily accessible when you need it fast. The ideal spot is usually a high-yield savings account.
Why?
Well, you want it separate from your regular checking account so you're not tempted to dip into it for everyday stuff. And a high-yield account pays a bit more interest than a standard savings account, helping it keep pace slightly with inflation. That's not its main job.
And accessible is key, right? Not locked away somewhere.
Absolutely crucial. This is not investment money. Don't put your emergency fund in stocks, bonds, or even CDs where it might be tied up or could lose value. It needs to be liquid and safe, accessible within a day or two at most.
Got it. Safe, separate, liquid. High-yield savings sounds like the winner.
Generally, yes.
So for someone starting from zero, building this up can feel, well, maybe a bit overwhelming. How do you actually do it? Step by step.
Yeah, it can seem daunting, but you break it down. Step 1, set a target. Don't fixate on the final 6-month number immediately. Start smaller. Aim for, say, $500 or $1,000 first. A mini goal. Achieving that builds momentum.
Okay, small goals first. Makes sense.
Step 2, automate it. This is maybe the most powerful trick. Set up an automatic transfer from your checking to your emergency savings account every payday. Even if it's just $20 or $50 to start, treat it like any other bill. Pay yourself first.
Out of sight, out of mind.
Exactly. Step 3, look for places to cut back. Review your spending. Are there subscriptions you don't use? Can you reduce takeout meals? Small changes can free up cash you redirect to the fund.
The classic latte factor, but applied to savings.
Kind of, yeah. And step 4, use windfalls wisely. Get a tax refund, a bonus at work, a cash gift. Resist the urge to spend it all. Put at least a portion, maybe all of it if you can, straight into the emergency fund until it's built up.
Okay, target, automate, trim, use windfalls. Seems doable, broken down like that.
It really is. Consistency is key.
And just like with APR, are there common mistakes people make with emergency funds? Things to avoid?
Definitely. A big one is simply not saving enough. Maybe sticking at that first $1,000 goal and thinking they're done when their real need is much higher.
Right, not adjusting the target as life changes.
Another huge mistake is using it for non-emergencies. Tempting as it might be, it's not for vacations, a down payment on a non-essential purchase, or concert tickets. It defeats the whole purpose. You have to be disciplined.
Discipline. Okay, what else?
Mixing it with other savings. Keep it in a separate, dedicated account. If it's just part of one big savings pot, it's too easy to mentally allocate it elsewhere, or lose track of how much is truly set aside for emergencies.
Keep it sacred.
Yes. And maybe the most common mistake of all, delaying starting. People think, oh, I don't earn enough right now, I'll start when I get a raise. But even putting aside $10 a week is better than nothing. It builds the habit. Small, consistent amounts add up remarkably over time. Don't wait for the perfect time.
That's powerful advice. Start now, even if it's tiny.
Absolutely.
Okay, so wrapping this all together, understanding these different AL finance options gives you more pathways. Decoding APR helps you compare costs like a pro. And building that emergency fund, well, that gives you resilience.
It really does. Taken together, these aren't just financial concepts. They're tools for building freedom, security, and ultimately confidence in your financial life.
Knowing how this stuff works lets you handle whatever life throws at you, financially speaking.
It puts you certainly in the driver's seat.
Yeah.
You're making informed decisions, not reactive ones.
So here's something to think about as we finish up. Imagine truly understanding the flow of your money, not just income, but how you borrow smartly, save effectively, and prepare for the unexpected. How much more confidently could you navigate life's inevitable twists and turns? What's the very first small strategic step you could take, maybe even today, to apply just one thing you've learned here and start building your own financial fortress?